Welcome back, folks. So in front of you having the Nasdaq emini futures, the December contract. So this is a daily time frame, and we are having the NAS trading to all-time highs again. So last week we had accumulation, and we ended up having Friday taking out the low that was formed on Tuesday. So Friday took out last week's Tuesday's low, making the low of the week and probably initiating a move going higher, attacking all-time highs again. So as you can see right here, we have a chart of this type. Had this massive drop. This was a Friday. So the Monday the market formed a fair value gap with the Thursday of October 9th, and we had this Monday turned into an inside candle as Tuesday took out its low and its high. So Tuesday took out the range that was formed on Monday, and then also on it took out the range on both sides. So that's formation of an indecisive market, knowing that we are to go into a consolidation later. Then we have the market continuing to form higher highs on Tuesday, Wednesday, and Thursday. So Friday drops, we open up right here, we drop going below Tuesday's low, taking out Tuesday's low, then we attack buy side. And what does that indicate? We are attacking. This Friday initiates a move going to the upside as it takes out this liquidity, like it makes the market fulfill its desires to go lower, in that the market now has to attack buy side. We cannot attack sell side anymore. We have tried trading back into this new weekly gap here from Friday's closure on the 10th of October and the 13th of October. This is a gap right there. We have traded into that, and Friday took out liquidity in the same gap. So this is a PDRA. I would want to give me price action higher. So we have that, and we have buy side at these highs, all-time highs. Okay, so Monday opens up, we have a pretty bullish day and a textbook bullish day for Monday. We have a new weekly opening gap right here. This you can call a volume imbalance. The market drops, forming the Judas swing, and then we rally higher. Okay, so if I am to put a line onto that, dropping onto the lower time frame, dropping onto the 1 minute time frame, so we are having the market opening up, we accumulate, then manipulate lower. So this manipulation happens going into the London session, forming the low of this day. So I would have this as my Judas swing right there. I'm going to make this yellow. Let's black it up, black, and I'm having this as my Judas swing. And note that where we are trading at in the daily fair value gap. that I talked about. So in the daily fair value gap, we are working around the quadrants of that. We have consequent encroachment as this dotted red line. We have the lower quadrant and then the low. The market pierces through that low. If I'm to zoom in into this price action, that so this is a classic buy there. We have the market opening up, so this is Sunday's open. The market accumulates, this is accumulation of orders, then we manipulate lower, forming the Judas swing. In the Judas swing, we have two legs, so we have this and this. So this final leg has to be a copy of this first leg. So from that to that is the same as from here to there, and the market drops down. So from this high to this low, that's our optimal trade entry. So if I'm to measure just like that, the market has to offer an optimal trade entry right there, and these are the levels right there. Market, this initiates the move going higher, but this happens during the London session. London session initiates a reversal for us, so we have a classic buy, and note that we have this compression within half of that Judas swing, half of that move that manipulates. So this is your threshold for this move if we are to reverse. So I'm looking at this, I want to surpass this, I'm having an entry right there. So I'm not bothered with that because I wanted to execute during the New York session. I'm having accumulation, I'm having manipulation, and for the rest of this day, I'm not looking for any move coming back lower to take out the sell side. So we'll have the market coming back into quarter of that range if I am to draw the quadrants on this. I am to draw the quadrants on that. This is the upper quadrant of that range, as you can see right there. That is the upper quadrant of that range. Okay, it comes back into that. I'm having a fair value gap with the volume imbalance right here. So if I am to zoom in, that is the bullish fair value gap. I'm not considering the whole of this because we have the market fulfilling this and leaving me a low. This low, I'm using this as liquidity going into highs just like that. So this is the unfilled portion of this fair value gap. Market drops, forms liquidity right there, then we have a turtle soup into that, and then we push higher. So for the rest of this day, I'm looking for the market to continue higher. Have the 12 a.m. to 12:30 opening range marked right here. So market works within that range into this day. So if I am to mark for you, we'll have our 7 a.m. the start of the pre-session, 7 a.m. and 8 a.m. Note that I'm looking for buys now. This has generated my bias already, and 9:30. Okay, so we happen to drop back lower. Now note this, we accumulate around the half of the daily fair value gap. We accumulate, and note that we are below the 12 a.m. to 12:30 opening range. We are working within the lower half of this. So the market comes back into that one more time, we trade into that, and it is held within this range. The market manipulates below this range, taking out sell side. So I know I'm satisfied with sell side, I'm looking for buys, and I expect the market to surpass this opening range going to 930 to give me an entry to take me lower. So I expect this range to be traded above and closed above, so I will look for an entry higher. The market drops, takes out sell side, and then we continue higher, going into the 930. So what range do I expect the market to move within this pre-market session? I expect the market to move to above the 12 a.m. to 12:30 opening range. Now if I am to draw those on the chart, we are going to see that we expect the market to go above this. So that is the range I expect the market to move. I'm drawing this before the market moves into that. So the pre-session, we have the market dropping lower. If I had to start our analysis at the pre-session, pre-market session at 7, market gives us a low. That low is taken out. So from this low to this high, looking for my optimal trade entry right there. We take out this low. I'm having a market that rallies back above and closes out the 0.618. This retest is your entry going higher. So if I'm to pull that off, we'll rally, come back into, I'm having this overlap and this volume imbalance. I'm using that as a whole thing right there. This as a bullish fair value gap. Market resests into that. We work on the consequent retracement of that, and then we rally higher, forming an order block on that candle's high. So that is a bullish order block right there. I want this to be precise as much as possible. Note the quadrants of the expected range. We have the lower quadrant. The market fails to close above that, and then when it closes above it, it is used as inside right there. So this week's failure, the bodies of these candles failing to come back below this is not random. We have this level that has been taken out, and in a bullish market we want this to be holding the 0.75. It holds that order block, then we rally higher. So this dotted line is consequent retracement of the daily fair value gap, and we managed to close above that and leave a fair value gap within that. How far can the market manipulate if we manage not to use this as, not to respect this consequent retracement to the tick, because this is a higher time frame level in price, so I expect a bit of manipulation to it. The market drops how far this order block and this level, market rallies above that, and then going into half of the expected range, market fails to close above that, drop this fair value gap and this order block hold the market, and then forming sell side. So we have the market forming an intermediate term high for this intermediate term high. If you are to go back into the lectures about the intermediate term high, an intermediate term high can also be a high that forms to mitigate a PDR. So I'm having a fair value gap here. I'm having a high that forms to fill this fair value gap. Have this short term high, and then market takes out this to form an intermediate term high, and then a short term high to the left. Note how the bodies of the short-term highs respect this half of the expected range to be moved, and I'm having this that the market disrespected right here, so I expect a bit of correction to that. The market drops and comes back into this order block right there, trades to half of the daily fair value gap, consequent encroachment, and then we form a volume imbalance to that. This body goes through it, the market corrects with the volume imbalance, just jumps, leaving this price unfilled, then we continue higher. we continue higher, managing to close cleanly above the half of the expected range that is supposed to be moved within the pre-market session. So within that, I'm having a volume. Now, why do I expect this closure to hold more than this? Because we have body closures above it, but they do not hold, and then we drop lower. We have the market showing you this is a sign that this is not going to hold. We are going to have a little bit of manipulation. We have a volume imbalance right there, and this fails to correct. If this closed below this, I would expect a little bit of manipulation and then going back higher. Now we form this at that and have a fair value gap in there with the volume imbalance. Extend that into price. This is a bullish fair value gap. Okay, 8 a.m. opens up, we come back into half of the expected range, and then we just work in the upper half of this bullish fair value gap. We fail to touch it, bodies respect the wicks to the damage, then we rally higher. Going into the 12 a.m. to 12:30 opening range. Going into the 12 to 12:30 opening range low, we fail to close above that. Market comes and manipulates, showing you that its intent to close above it. Then accumulation of orders. I'm having an inversion fair value gap just there. Having an inversion fair value gap just there, then we rally higher, closing, and the market uses this as support. So we go on attacking the levels within this. So not this line. This is the upper quadrant of the expected move. We close above it, we use it as support right there, and then we rally higher. That is the expected range I expect the market to move. This is the pre-market session. Going into these highs, I'm having this and I'm having this right here. Okay, I have the daily fair value gap high at that. So we managed to go above that within the 8 a.m. going into the 9:30. We managed to close above it, and I expect not that we are trading above the 12 a.m. 12:30 opening range before 9:30 opens up. So I expect 9:30 to refer to that and then drop and then rally higher. So we have that market comes into this. We have another block at that, but I'm looking at this. Market fails to reach the upper quadrant of this 12 a.m. 12:30 opening range, and then we just rally higher. So if you did not, because I will have no confirmation of this here, if you had went in aggressively and used this as your execution, a stop loss and consequent encroachment of that, or this low, then you would have called this trade. But I do not advise that, because no one knows that this is going to react like this. So we trade into that. Market rally is higher, closing above the daily fair value gap high. So I'm looking for any entry that can give me buys. I'm having a balanced price range here. This week trades, this candle trades up, comes back down, and then this trades into that, rallies back higher. So I'm having these wicks here to this week. So this is a range I expect the market to respect. Extend that into price. I expect the market to come back and trade into this, but how far can it trade into that? Half of it. This is acceptable. Look at the bodies right here. The bodies stay at, so if I'm to make this late, just like that. This can be your execution, market trading back into that range, or I'm having, if I'm to put this off, I'm having optimal trade entry that was provided here, having from that low going into that high. Market closes back above the 0.618 and then there goes above the 0.618. Market refers into that one more time and then we just pull higher. If you didn't take that, there are multiple entries to this, having a reclaimed fair value gap here, market going below that, reclaiming this for its row, and then we'll rally higher. That is a reclaimed fair value gap. Consequent encroachment of that respected, and then we'll rally higher. Or if you didn't take that, I'm having a bullish order block. So if I'm to draw to from that high to that low and tag on the main threshold of that, showing you the main threshold of that, firmly respected. So this is a bullish fair value, a bullish order block, sorry. So there is a lot of confluences within this. The market offers a lot of entries to make up for this big move higher. To enable the big movers enter the market within this. And what happens after that? We just rally higher. The market continues trading higher. Now, what am I going to use for my take profits? So if I am to measure this Judas swing, gives me my note the 2 standard deviations of that range right there, and this is not that accurate. Note the 2 standard deviations and the 2.5 standard deviations of that. Look into that. If I am to elongate that into price, what does the market trade into? A 2.5 and the 2. This market gives you 2 standard deviations of this range. So have this one more time, from that to that, there to the 1, and then to the 2, just like that. So this is what you would have targeted for the day, and your daily range would have been given to you just like that. That's what I would have been aiming for a classic buy day. I'm aiming for 2 standard deviations of that Judas swing and the market rallying higher. Daily fair value gap, I've talked about that, and this Judas swing, if I'm to extend that into price, market comes back into that and then gives back a rally. Okay, so I think that's it for today. Thank you for tuning in. I think we shall meet in our next lecture. Hope you found this insightful. Thank you.